Let me ask you a quick question. Is your company car secretly draining your bank account through tax? Well, for thousands of directors right across the UK, the answer is a big fat yes. And with major changes on the horizon for 2026, HMRC is about to turn up the heat.
It's a really serious issue. So many people are losing a chunk of their hard-earned money on their company vehicle, and they don't even know it. The rules are changing, and honestly, if you're not ready for it, you could be facing a much bigger bill. But the good news? You can totally get ahead of this.
And that is exactly why we've teamed up with the experts over at My Tax Accountant for this discussion. They live and breathe this stuff, helping business owners figure out these exact changes. They've helped put this whole thing together to make sure you have the info you need to make the smartest choice for your next car.
Okay, so here's what we're going to cover. First, we'll expose the company car tax trap. Then, we'll get into the nitty-gritty of how HMRC actually calculates your bill. We'll pit petrol, hybrid, and electric cars against each other in a real-world cost battle, and then look at the new so-called penalties coming for EVs. Most importantly, we'll then walk through 4 smarter ways to drive before wrapping up with what you should do next.
Right. Section 1. The company car tax trap. You know, a free company car, it sounds like one of the best perks going, doesn't it? But here's the thing. In the eyes of the tax man, it's almost never actually free. Let's dig into why.
So, this whole system is built around one key idea, benefit in kind, or BIC for short. All this means is any perk you get that isn't cash but has a real monetary value. And because it's valuable, HMRC wants a slice of it. For a company car, this tax kicks in the second it's considered available for your private use.
And that brings us to probably the most important question in all of this. What does HMRC actually mean by private use? I'll give you a clue. Their definition is probably way broader than you're thinking.
Okay, this is where so many people get tripped up. HMRC's definition is huge. Your daily drive to and from your main workplace? Yep, that counts. Popping to the shops or doing the school run? That counts too. But here is the real kicker. Even when the car is just sitting on your driveway overnight, it's seen as available for private use. So in HMRC's world, if you've got the keys, you're getting a taxable benefit.
So let's move on and see how this all adds up to your final tax bill. Because once you understand how HMRC works it out, you can start to legally bring it down. It all comes down to a specific 4-step formula. Now, the very first piece of this puzzle is something called the P11D value. This isn't the price you haggled for at the dealership, it's the car's official list price, and that includes VAT and delivery charges. It's super important to know that it doesn't include the first registration fee or your annual road tax. This P11D value is the starting block for the whole calculation.
Okay, so here it is, the 4-step formula HMRC loves. First, they take that P11D value. Then they multiply it by the benefit in kind rate, which is a percentage that's pretty much all about the car's CO2 emissions. That little bit of maths gives you the taxable benefit for the year, and finally, you just multiply that number by your own income tax rate, whether you're at 20% or 40%, to see exactly how much cash you'll be paying.
And that's really the heart of it. The whole system is designed around one simple rule. The dirtier the car's emissions, the higher your bill's going to be. It's the government's way of giving everyone a big nudge towards greener cars. And it means your choice of vehicle is one of the single biggest tax decisions you can make.
Okay, on to Section 3. Let's make this real. It's all well and good talking about formulas, but it's another thing seeing the actual pounds and pence. So we're going to run a real-world comparison for the 2025/26 tax year to see what this looks like in black and white.
To do this, let's imagine Alex. Alex is a sales director in London, a high-rate taxpayer, so they're paying 40% income tax. The company's offered them a new car, and the decision Alex makes is going to directly hit their monthly take-home pay.
So, Alex is weighing up 3 options. First up, a standard petrol car. It's got a P11D value of £30,000, but its high CO2 emissions lands it in a pretty painful 34% BIK band. Option 2 is a plug-in hybrid. A bit pricier at £34,000, but because its CO2 is so low, the BIK rate plummets to just 9%. And finally, a fully electric car. It's the most expensive up front at £42,000, but with zero emissions, it qualifies for a tiny 3% BIK rate.
So what does this actually mean for Alex's wallet? Well, if Alex goes for the petrol car, the tax bill comes to a whopping £4,080 a year. That's £340 a month just in tax for that free car. Ouch, that is a massive dent in your payslip. Now, let's switch to the hybrid. Even though the car itself costs more, that little 9% BIK rate changes everything. The annual tax bill drops all the way down to just £1,224. That's a saving of over £2,500 a year compared to the petrol car. You can already see how important this choice is.
But the electric car, well, the electric car is the clear winner here. Even with the highest price tag, that tiny 3% bike rate means Alex's tax bill for the entire year is just £504. For a premium car, that's incredible. But stay with me here, because the rules for these EVs are about to get a bit more complicated.
And that takes us straight into Section 4, the new EV penalties. See, just as everyone's getting used to EVs being the tax-friendly darlings of the company car world, things are about to change. The so-called free ride is officially ending from April 2025 as the government starts to normalize things now that so many of us are switching.
There are two big changes coming. First, road tax, or vehicle excise duty. From April 2025, EVs will have to pay the standard rate, just like everyone else. And second, and this is a big one, the expensive car supplement. Any new EV registered after April 2025 with a list price over £40,000 is going to get hit with an extra $390 charge every single year for 5 years. That's a brand new cost of almost $600 a year for those premium EVs.
And it doesn't stop there. The government has already laid out its plans to slowly increase the benefit-in-kind rate for electric cars. As you can see, it's set to creep up by 1% each year. It'll still be way, way lower than a petrol car, but the direction of travel is crystal clear. That tax gap is slowly starting to close.
So, after hearing all that, you might be wondering what on earth you're supposed to do now. Well, that leads us perfectly into Section 5, 4 smarter ways to drive. This is where we get into the actionable stuff you can do to legally slash your tax bill. That's not all. Here's where you can make some really big savings.
Okay, pro tip number 1, look into a salary sacrifice scheme. These are absolutely brilliant, especially for electric cars. Basically, you agree to give up a small part of your salary before any tax is taken off. In return, your company gives you a brand new EV. The result? You pay less income tax, less national insurance, and your company saves some money too. It is a genuine win-win.
Now for strategy that might surprise you, I call it the van cheat code. See, unlike cars with their complicated tax formula, vans run on a simple, low flat rate system. For the 2026/27 tax year, the taxable benefit is just £4,170. And here's the best bit. For an electric van, the taxable benefit is zero. Absolutely nothing. It's an unbelievably tax-efficient way to go if a van actually works for your business.
But hang on, what if your heart is set on something a bit more fun? A high-performance petrol car, maybe. Something that's amazing to drive, but let's be honest, is a total nightmare for benefit-in-kind tax? Is there a smart way to do it? You bet there is.
The answer is strategy 3. Own the car personally and just claim mileage. By doing this, you step outside the company car tax system completely. Instead, you just charge your company for business trips using HMRC's approved mileage rates. And here's the key part. The money you get back from the company is completely tax-free income for you. For high-emission cars, this is almost always the smarter way to do it.
And finally, strategy number 4 is all about being tactical. It's about playing the game within the company car scheme itself. Remember those two things HMRC cares about, emissions and list price? The goal is to keep both as low as you can. If you pick a hybrid under £35,000 or an EV under that crucial $40,000 mark, you can keep your tax rate in the single digits and completely avoid that new expensive car penalty. It's about making a savvy choice from day one.
And that brings us to our final section, your next move. We have covered a ton of ground, from the tax traps all the way to the smart strategies. Now it's about taking that knowledge and turning it into action and getting the right advice for you.
Look, if there's one thing you take away from all of this, let it be this. Your choice of car isn't just about what you like to drive. It's one of the biggest tax decisions you will make. Getting it right today, based on the rules for 2026 and beyond, can literally lock in thousands of pounds in savings for years and years to come.
Now, before we finish, I have to make this really clear. The information we've talked about today is for general guidance. It's here to give you the lay of the land, but you shouldn't rely on it alone to make your final financial decisions. Everybody's situation is unique.
And that is exactly why, before you do anything, you must speak to an expert. For personalized advice that's tailored to your company car, your business, and any other tax questions you have, you really should talk to the specialists at My Tax Accountant.
They can run the numbers for your exact circumstances and show you the most tax-efficient way forward. You can give them a call on 02-08-570-8531 or drop them an email at info@mytaxaccountant.co.uk. Don't leave thousands of pounds on the table for HMRC. Get the right advice today.